Hey guys, welcome back to my YouTube channel. So on my page, if you all have been watching my videos, I have been talking about a recession and a recession looming. And I'm not obviously trying to be a sort of a pessimistic person. It's just, the facts about how the economy is shaping up, and something that everybody should be wary of. And even if I am not like entirely correct, the point is we're still late cycle. So the risk reward at the moment is very poor to sort of get into markets if this is the first time you're getting into markets. And if you have been in the markets, it is a good time potentially to take some money off the table and keep it in your savings account or your checking account, because it could definitely come to good use when the market does tank and valuations get really good. But anyway, so the reason why I want to make this video is sort of explain why the next recession is going to be so scary and so frightening, and why it's going to be different and quite severe in my opinion, compared to last couple of ones. And the main reason it comes down to is two things: monetary policy and fiscal policy. So this is sort of a small, quick economics class, if you will. But monetary policy, as you can see here, is linked to interest rates and QE, so quantitative easing. Now, as we all know, the Federal Reserve, Jerome Powell, is been rate hiking in the last few quarters, and he has obviously in the quarter of this year come up with a dovish tone and said that, look, I am not looking to sort of potentially raise rates this quarter, next quarter. It looks like the probability of a rate hike this year now is very slim. So that's pushed up the markets. The markets are up 10-15% from its bottom. So that's obviously holding the markets up currently. QE is also another form of monetary policy, basically, which central banks use when recession happens. What they do is they basically essentially print more money into the system, which basically so buying up assets and stuff like that. So the reason being is to provide liquidity into the markets and also to help prices come back to stable levels. The reason, so monetary policy, so linking it back directly to a recession, the monetary policy, two things that central banks do is they lower interest rates and they start QE program. So when recession goes down, the reason why they put the interest rates down is so people can borrow money cheaply, and then the idea would be borrow money to invest back into markets, into economy, to help stabilize the economy again. And QE is the same thing, but with money supply. So they're putting more liquidity in the system and buying up financial securities like stocks and bonds to help prices come back to better levels, obviously, because when markets tank, stocks tank like 50-70%. So that's monetary policy. So fiscal policy is when central banks use the aspect of taxes and the way they spend their government money by helping the economy. So for an example could be when markets tank, recession goes on, there could be a system. What they do is they start charging banks, allowing them to have more of a recurring interest, and allow banks to have a lower interest tax bracket, so they can allow more stimulus into the businesses, which will then ultimately go down to the employees, into the consumers, and back into the economy. Now, the reason why I say the next recession is going to be so scary is because fiscal policy, what are they going to do now? As you all know, Donald Trump has done very good fiscal policies, if you will, in the sense by lowering taxes. So he's pushed up earnings in companies, given more money down to consumers, employees. They got bigger bonuses, they're going out spending money, they're happy, the economy is going well, and which has done well for the economy. The economy in the US is doing well. GDP is now giving a 2%, and unemployment is low, and is low 3 handles or something like that. So it's doing good. So the problem though is now, because the fiscal policies are getting so exhausted and are getting used, what fiscal policies can they do when a recession happens? Taxes have been cut, financial regulations have been cut down. So what fiscal policy can they use to help stimulate the economy again? So that's what I'm saying. Fiscal policy is a big problem for them. What would they do to try and help the economy when a recession happens? Because it's already been exhausted currently in this market. So the only thing that they mainly could focus on or could do is in the monetary policy aspect of things. But then the problem with that is in the last 10 years, if you look at the interest rate right now in the US is roughly about 2.25%. And that too is because recently there's been a lot of rate hikes in the last year, 2 years, if you will. But before then, there's been interest rate for so low for so long. So you can, so if interest rates are not at a normalized level, which they're not currently, they're at 2.25%, then how would they have that opportunity to use to bring that interest rate down as well? I.e., if interest rates were 3-4%, then it would make sense, because when a recession happens, they can bring that down all the way to zero slowly to help stimulate in the economy again. But if interest rates are already not that high, around 2%, and they're below nominal interest rates, then how are they going to help use that as to stimulate the economy? Which is why the central bank is in a really sticky situation at the moment. And because in one way, if they do not raise rates, they're allowing the economy to overheat. And they don't, that way they won't have anything to use when a recession does happen if they don't interest rate raise now because they can't lower it. So that's the reason why obviously I've been talking about why I'm being short the market, because Jerome Powell would have no option but to start raising rates for two reasons. One, to then use that to decrease rates for when recession happens, but also to get the interest rate back to a normalized level. And QE is the same thing. So that's what I'm saying. So if you look at those fiscal and monetary, fiscal policies is hardly any policies to use. Monetary policy, interest rates is still in a wishy-washy thing. QE is something that they could start doing again effectively. But that's the whole point I'm trying to mention, is that the central banks are sort of tied to not many aspects that they could use to help stimulate the economy again, which is why the next recession is going to be horrible, because there's hardly any stabilizers. What stabilizer would they be able to use to help stimulate the economy again? And that's why, God forbid it doesn't happen, but it will. The economy, when it starts to tank, you'll go into free fall and you will get a massive crash. We had a quick succession of 20% drop in the last quarter in 2018. But that number could look really, really small when we get an actual recession coming in, say, the next 12 to 18 months, which is why I'm short the markets. And something that you should think about adding to your models is about the different fiscal and monetary policies that central banks could use, and how can they prevent, that's why they're trying to prevent the economy from recessionary measures right now. And that's why Powell has been so dovish and said, okay, look, I'm not going to probably raise rates this year. And that's why it's helping the economy to go back on track. But again, it's inevitable, right? So this is just temporary measures that's being taken to sort of keep the economy to be afloat. But when it gets going, it'll become nasty. So yeah, I thought I'd make this video to sort of just explain a bit more about my thesis, because I've made a lot of videos about it, and I'll continue to do so because I'm very, very strongly believe in the markets coming to its sort of end. So I hope you guys enjoyed this video, and I'll see you guys in the next one. Bye.